What is going on? Today we are talking about stop and target locations. So this is something I'm pretty passionate about because I see a lot of bad information out there in the ether about how to actually properly manage a trade. Now, before we talk about how some of the different ways you can go about managing your trade, I want to just first hit on why it's essential you understand trade management, right? So your expectancy, which is what you live or die by as a trader, right? That's telling you, hey, are you a profitable trader or not? Do you have that positive expectancy? That's a combination of your win rate and your average risk return that you get on your trades. So, if you are a decent, good trader, right? Some of the best traders I know over the span of their career have about a 40% win rate, right? So, with a 40% win rate, you got to have adjusted risk return in your favor to be profitable, even marginally, right? So they toss out numbers. Oh, 3 to 1, 2 to 1, all these different things. Oh, just set your stop loss at 1% and take 10% or 3% or whatever it is, right? That makes no sense. Where are they pulling those numbers out of? They're not, that the market doesn't care what your account balance is and what 1% of your account balance is. That's ridiculous. You should be trading what the market is telling you. Be open to interpreting market generated information and making decisions based off of that information. Your account should have small losers, small winners, and big winners. That's it. What is missing in that combination? Big losers. Big losers should not be a part of your account. You should never have a big loser because you understand how to manage your risk. You have a systematic way of setting a stop loss, and you do not touch that stop loss after it is set. You set it where it needs to be, and then you don't touch it. If you can't handle that, you're in the wrong industry. Okay? Go buy some self help books. So, what is stop loss? What is the purpose of this device? It is how much am I willing to risk in my capital to find out if this trade will be a winner or a loser. You will have a large distribution of winners and a large distribution of losers, right? So the question has to be asked, when is the trade idea invalidated? When is this trade that I am taking, when do I know I was not correct or whatever, like my setup did not work? I don't want to use the word correct because you don't know what the market's going to do. You shouldn't be anticipatory. When do you know your idea is no longer valid? That is where your stop loss should be. So in most cases, for the way that I trade, that's at the swing low. If I enter in on a pullback, I'll set my stop loss at the swing low because I know if it goes below that, it's no longer the swing low. Now something's changing. If I'm buying pullbacks in a bullish trend and we start pushing down that swing low, well, guess what? Now that's a lower low and you're no longer in a bullish trend, okay? So that is how you determine it. Now, I might say I'm not willing to risk more than 20 ticks in crude oil on a single trade, right? So in that case, yes, there is a static number in my risk management plan. However, that's just a trade you don't take then. If you have to risk more than 20 ticks in crude oil, then you shouldn't be entering. You already missed your chance on that pullback, right? 20-cent move is that's already a large chunk of whatever rotation you get in most cases for the harmonics of crude oil, right? So that's kind of a ridiculous situation to begin with. But maybe it's 10 ticks, right? So 10 ticks, you will not lose more than $100 per contract in crude oil via your risk management plan. So when you enter into a position, you set your stop at the swing low. If the swing low is more than 10 ticks, then you entered too late. And if it's, it's discretionary. If it's a tick or two, then yeah, you can have it punch into the swing low by a tick or two. That shouldn't be a big deal. But if it's like in the middle of a rotation, then you got in too late. You need to get out of that trade and wait for another pullback or wait for another qualification because you were too late. Okay, so you should have a number of the maximum amount of money that you're willing to risk on a single trade. because that goes into how you calculate your daily loss limit. So for me, if I am saying 10 ticks is the most I'll lose on a single trade, and I know that if I lose 3 trades in a row, something's wrong either with me and how I'm trading and my own mental state, or I am just not in a current market situation where I have edge. Either way, that's my daily loss limit, is 3 times whatever my max loss limit on a trade is. Let's talk about profit taking. So again, profit taking is extremely important. It's just as important as being able to actually get into a position in the first place. And it's something that it's the hardest thing to learn, is knowing when do you take profits, when do you're never going to get the very tippy top tick. Very rarely will you, right? So there's a few different approaches, right? Just as far as managing your profit taking, there's an all-in, scale out model and a scale in, scale out model. Those are the two primary ones that you hear people talk about, right? So that's where if you trade 10 contracts, you enter your position 10 contracts deep. Now, say you're in crude oil and you say the market harmonics right now indicate that an average rotation in my favor would be about 15 ticks. So when you get 15 ticks up in your position, maybe you take 1/3 of your position off, which you can't do with 10 contracts. So maybe you take maybe you take a different amount off. You take 3 or 4 contracts off, whatever it is. Then that is your scale. So that's your profit taking, and what that allows you to do is kind of smoothen out your equity curve along the line. And then the rest of your position, that core position that you have remaining, is where you're stretching that trade to see how far it'll let you go. That's not something where you have necessarily some static rule of, oh, if it hits this amount, I have to hit. No, stop. That's silly. That's gonna, that you're defining how profitable your day can be before your day starts. That's ridiculous. You want to squeeze everything that you can get out of that market. So there's a few ways to do that. There's structural, meaning you have targets based off of market generated information above, whether that's a recent failure, whether that's market profile, prior value, point of control, something like that. And that's where you're planning your I shouldn't say expectation. That's where you believe the market has a high probability to go before it hits that inflection point and turns around. Okay? So that can be one way, and you reach that target and you hit that target, or you don't hit that target, and when you start to see the market turn over, you take profit. Then there's algorithmic, which would be something like once you enter into a trade, you have a 21 moving average, and after your position is 15 ticks above your original entry, it starts to trail your position via that moving average, something like that. So those are all different ways, and you can back test it and see how it would work with your trading system. But there's definitely pros to having an algorithmic system like that, especially when you're new, because that just takes the stress out of managing the trade. Gone. All you have to do is enter your trade, set your first target wherever the harmonics tell you that you have a high probability of that rotation ending up, and then walk away. You're done, right? Go watch Netflix while your trade works or something. I don't know, right? So that's the crucial components of profit taking. Is again, it's dynamic. Squeeze as much as you can out of that market, because those big winners are going to make up for all those small losers. Let's look at a few examples. So here we have this value area, this distribution, this range that we're trading in, and we come down to this value area low, as well as the developing value area low. You see us push down, come up, hit VWAP, come back down, retest it, and now we're starting to push back up. So let's say your system says you're allowed to get long here. So you buy right here where this white dot is. And where do you know that idea is invalid? Where do you know that you're wrong in this trade if you're saying this is that pullback and that swing low? Right there at the bottom, that swing low. Because if you're up here and the market trades all the way back down here, it's got a much, much higher probability of pushing down and becoming imbalanced to the downside than it does to return back to value. So that's where you know the idea is invalid. And in this case, it's 6 ticks. So if you're one of those people that's risking 10 ticks on every trade, then when, that's 4 ticks of slippage now that you're losing when these trades don't work out, just because you're not adjusting your stop loss to where the structural idea or the ideal structural place for it to be is, right? So now you're in the trade, it's going, it's going, it's going. Maybe you have a value area high here, or you have, see where this prior high is, and say, oh, if we can get to this prior high off of this opening drive, then that's where I'm interested in taking profit. So, maybe you take profit right there. And if you're one of the people who had a all-in scale-out program, then maybe at this developing value area high is where you scaled, right? You scale part of your position out, and it comes down. Maybe you scaled up here. It's really, that's, the scale is quite discretionary. You're just taking profit when you expect that rhythm to go. However, it would be kind of silly to scale here. If you look at this market's rhythm on how big these rotations are, boom, 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 and it changes right here. However, you would have been expecting a little bit of a larger rhythm right there. Nevertheless, so you have a systematic way to understand where you should be taking profits. It's not, oh, once it gets 20 ticks in my favor, I take it, right? And again, this is where that trade idea is invalidated. Let's look at this one. So we're bullish trend, bullish trend, bullish trend, bullish trend. Start to press back into value. Hold, 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 hold. Starting to have slippage on this moving average. Okay, cool. Now say this qualifies as a short. Stop loss is right here. Entry is right here. If it goes back up here, the trade idea is invalidated because it means it's going to start returning back to this little mini distribution it formed, right? Your probability lies in, oh, it's falling to the downside. Maybe you've got order flow. Maybe you've got whatever fancy tool you're going to use. I don't care. In this case, ooh, this is scary. 11 ticks. Maybe you could have made it 10, and I just put the dot in the wrong place. I don't know. But that's where you're putting your stop. You're not putting it here. You're not putting it there. You're putting it where the trade idea is invalidated. In this situation, that's where it would be invalidated. And then your target, developing value area low. That'd be a pretty typical expectation for high probability for a trade like this. Boom. You hit your target, you're fine. In this case, you would scale at VWAP. All right, last example. You're kind of in this open auction you got, or not open, this auction that you have going on here. Push up, press into VWAP, pull back down, and you're retesting off of this moving average. Maybe you see order flow, whatever, you enter the trade. Actually, this is where I had it. This is kind of a crazy trade, actually. So you push back down. It looks like it's failing off VWAP, but then it comes back up. So you see it coming back up. You get into the trade up here. Are you going to set your stop here? No, because you're trading off the swing low in this case, right? So you set your stop loss at the swing low. In this case, you're risking 16 ticks. Maybe that is something where you're too late in the game. And if that was something where you're too late in the game, well, guess what? Look what happens right here. Pull back to VWAP. You could enter right at VWAP and have a much, much, much tighter risk. So that's why I'm saying if you say you're not going to risk more than 10 ticks on a trade, that's brilliant. Don't do it. This is not a trade you would be taking. You would be waiting for that pullback right here to get yourself involved. So now you're in the trade. Now you maybe scale out some when you get to this value area high. Comes back down, hits VWAP. And this is where your stop loss can get kind of tricky, because if you had that algorithmic system, you probably would have gotten stopped out right around here, where it's trailing it with the stop loss. And that's not to say you couldn't get back in. However, that's where discretionary targets can kind of come in handy. And this also has to do with where you set your stop. So if you did get in, setting your stop at break even, that might have tagged you out. So either way, this was kind of a tricky situation where you had a pretty high probability, if you were long here, of getting kind of wicked out of the trade from this distribution here. And that's just, that's trading. You can get back in it, right? So you get back in it, whatever. Maybe you scale some, right when we break into this area, or maybe it was right here at this developing value area high again, right? And you see it press down. This would have been kind of where you're cautious, getting ready to take profit, because if it spills below, you want to get out, but it shoots back up. Now we're outside of the +2 standard deviation and holding right here. Maybe you exit the trade or take profit here, and then it spills below and you exit at the close. So look at this. We have a 72 tick win, right? If you're someone who takes profit at 20 ticks every single time, well, guess what? You just gave up 50. What is that? Shit, 62 ticks? Yeah. No, 52 ticks. Yeah. Wow, I'm stupid. Okay, so 52 ticks. That's $520. That's maybe 5 trades now. 5 stop losses you could have erased if you had just managed trades properly instead of arbitrarily. So, overview, stop loss and target locations are generated from systematic processes. They are not fixed, they are dynamic based off of market generated information. You must be able to squeeze your winners and cut your losers to give yourself the RR required to have a positive expectancy. Targets should not be determined by an arbitrary profit goal or number. Squeeze those trades, baby. Squeeze them.